Welcome to Business Trainings, talking you through the most important steps of starting, maintaining, and succeeding in small and medium-sized business. I'm Jeremiah, and this is Access to Capital. What is the most important thing you need to make a successful business? Of course, you need to have a great product or service offering that makes your customers' lives better. You need a great team, an effective marketing strategy, customer focus and engagement, efficient operations, and more. But one of the most essential things for a business is capital. Yes, when you want to start a business or make your business bigger than it already is, whether that is by adding a new product segment or by entering a new country with your current offerings, you need capital or money that can help pay for things like a new office, a new research team, manufacturing units, new sales channels, and etc. And where does this capital come from? You might have some savings, but that might not always be enough. So you need to think about getting funding from investors and lenders like banks who believe in your brand and who would be willing to give you some money in exchange for benefits such as equity, profit shares, dividends, etc. When you start thinking about funding for your business, there are a number of things you need to keep in mind to ensure success. There are 7 main drivers for funding. The first 5 are called the 5 C's of credit, and they are used to gauge your credit worthiness. We start with character. This is simply the image that you are able to create of yourself and your brand in a lender's eyes. It is how good you look to them, in the sense of how reliable you would be in your commitment to give them the promised returns. This criterion is mainly measured by your credit score. On average, anything above 650 is usually considered a healthy number, which tells the investor that it would be a safe bet to put their money in your brand. Apart from your credit score, lenders might also judge you by other factors, including your past work experience, your credibility and reviews from your past colleagues or associates, your knowledge of the industry and business ecosystem, your hard and soft skills, and many more. The second C is capital, which is basically the base amount that you need to raise to get your plans in action. Think about the scope of your project and how much it will cost. You need to figure out how much of your own money you can put in and how much of someone else's money you need. The results you plan to deliver with the money plays an important role in whether an investor decides to give you funds. So, you need to meticulously plan out how much money you need and what for, whether it is a short-term like a line of credit to get through the next few months, or longer-term investment capital to purchase new equipment or facilities. The next C is cash flow or capacity. This is basically the amount of revenue you would need to be able to repay the amount that you would be borrowing from the investor or lender. You want to look at how much cash your business generates over a certain period of time so that you can determine how much you'll have available to pay back the loans or dividends on time. For this, you need to make careful projections about what your cash flow status would be in the future, so that you can plan payments in a way that will also allow you enough funds to pay for the daily expenses of the business. The fourth C is collateral. This mainly comes in as a part of securing a loan from a bank or comparable financial entity. Collateral is basically a secondary source of repayment that you use to back up the loan. In simple terms, this is an asset that you promise to forfeit in case you are not able to pay the loan back in a timely manner. It can be any type of asset, including buildings, equipment, accounts receivable, your inventory, personal savings, your home or real estate assets, a personal guarantee from a third party, or anything else that the bank might be willing to accept. The last C is conditions. These are things that are happening in your business right now, trends in the industry as a whole, and what the state, city, and local economy looks like, and how these things might affect your likelihood of securing and paying back capital. Is your business starting to grow, or is it faltering? Are lenders being cautious? Has the economy taken a dive and people aren't spending money? Conditions are present at all different scales and will impact how long it will take you to produce results, earn money, and pay back your loan. Then comes the 6th driver for funding, time frame. You should think about how much time different aspects of your project will take. How quickly do you need the money? How long do you need it for? What's the duration of your project? How long will it take for that money to produce results? Lenders will be evaluating your project's time frame when deciding whether to give you funding. The last driver is bandwidth. This is your capacity to pursue funding that could take months to secure and make good use of the funding you receive. For example, if you look to a crowdfunding campaign as a source of capital, you should know that it takes a lot of bandwidth. You will need a lot of time, energy, skills, and resources to pursue this type of funding. Investors might pull back if they do not feel that you have the right bandwidth to execute the project. So it is crucial that you can convince them that you, in fact, can make it happen. And all these drivers combined will be considered and evaluated by investors or lenders when deciding to give you the funding that you've requested. They can also help you decide what type of capital might be a good fit for your brand and your project. We recommend starting your search for capital locally. Look around your community to find people who would be willing to put in money in good faith. People who know the local markets and know your brand so that you can get more leverage in case you need a little flexibility to adjust to the unknown circumstances that almost every business faces when getting into new projects. Talk to your SBDC and local economic development professionals. There are a number of sources of capital, and this is what we call the capital landscape. The traditional capital landscape consists of the sources of capital that have been around for a long time and that most business owners are aware of. The debt sources of traditional capital are international trade, the funding resources that are earmarked for international trade in terms of lines of credit or guarantees. Banks and credit unions located in your local community offering a variety of lending programs. Credit cards, which could be beneficial in taking out lines of credit for short-term, smaller projects. Lines of credit. These typically require a good credit score or money housed with the institution. Typically, you draw down a line of credit for short-term needs, then pay it back by the end of the year. Government loans, such as SBA EIDL loan and the SBA Debt Relief Program, Regional Business Economic Development Loan Funds. Government loan guarantees. These programs provide lenders loan guarantees similar to insurance coverage and help to reduce the risk of losses to lenders, making it possible for them to approve loans that they may not otherwise. Home equity lines of credit. These leverage personal home equity on a residential property. This allows homeowners with personal income to qualify for a second mortgage that frees up working capital for other uses. Interest rates tend to be quite low. Leasing vehicles and other capital equipment allows business owners to expense lease payments and typically does not count as a business asset until the leasee buys the asset at the end of the lease. Leasing typically reduces the amount of upfront owner equity required to obtain new equipment. Equipment financing programs are loans to purchase equipment, where the equipment is also collateral for the loan. Vendor terms, where you ask for a certain grace period to pay the amount owed to your suppliers. Personal borrowing is where you obtain money by taking loans from friends and family. Now, apart from these loan sources, you could also get money through investments. This could be you putting your own savings into the business, getting investments from friends and family, or adding partners to the business. And last but not least, in the traditional capital landscape are the angel investors and venture capitalists. These are the people who usually put varying amounts of money into your business and ask for a certain percentage of your company in return. This means that you will be paying them regular payouts based on the profits you make annually. In this case, you need to be careful to not give too much of your company away. Always make sure you have a majority share so that you have the last say in all the business decisions. Now, apart from the traditional methods, there are also some alternative sources of capital out there. Debt sources include seller carry. This is where the owner self-finances via direct loan with interest to the buyer. Community development finance institutions or non-traditional lenders, they receive funds from the federal government to lend out to businesses to fill in the gaps where traditional lenders leave off. Community capital debt securities. This is when a business owner asks for capital from the local community as a loan. Factoring. This is a short-term cash flow management solution where you get an advance on accounts receivable, usually 80 to 90%, in exchange for giving up a percentage of the payment and finance fees. Merchant cash advances. This is a type of upfront term loan for working capital typically repaid with high interest rates out of a merchant services account. Online unsecured lenders. They offer term loans and working capital lines of credit. Most of this debt is unsecured, meaning there is no collateral, but due to the high credit risk of unsecured loans, interest rates generally reflect this with higher rates than the traditional credit programs. Asset-based lenders use business assets as collateral to provide access to non-bank lines of credit or term loan products. Certificate of deposit is where you ask a third party to make a certificate of deposit in a bank, which acts as a collateral for your loan. Crowd-funded debt or prepaid sales is where you ask people to lend you money without expecting any interest repayments or where they're expecting a product once you are able to manufacture it. Just like alternative debt sources, there are also alternative equity sources. These include seed funds. These provide small startup capital investments in exchange for a small amount of equity, mentoring, and sometimes incubator space. Retirement funds, which is using your retirement funds in the present. Few people recommend this as it is essentially taking away from any financial security you have for your future, as businesses are often risky. Community capital equity securities. This is where a business owner promotes their own project in the local community and asks for investments. Licensing of intellectual property you own, such as software for money or royalties. Grants from different types of public, private, and nonprofit organizations. Crowd-funded equity or reward-based crowdfunding. Here you ask people to donate to your business with nothing in return or exchange for the promise of rewards that typically cost less than their investment. All of these sources of funding have their own pros and cons, but it is upon you to decide which will work better for you in the long run. So, before you go out trying to get capital for a new business project, make sure you have considered everything that could help you make the right choice.